Welcome back, class, to part 2 of our video lecture for chapter 7, where we're covering itemized deductions. So let's take a look at the next category of itemized deductions, which is interest deductions. Here, interest expense can be classified into two groups, the deductible and non-deductible. So we learned about one non-deductible interest in past chapters, as if you borrow money to buy municipal bonds, muni bonds, the interest on these bonds, interest income, is tax-free. So if you borrow money to buy this type of bonds, the interest on the borrowed money is non-deductible. Also, personal interest, you borrow money and use it for personal purposes other than the amounts listed here, then that interest is non-deductible, like an auto loan if the auto is not for business use, or you're using your credit cards and don't pay off your balance, and that credit card is used for non-business purposes. The interest on that loan balances are non-deductible versus interest that is deductible. It can be classified into two subgroups. One is the four type deductions that we learned about in previous chapters. That would be interest or loans borrowed for a trade or business or a production of income activity like the rental property we've seen before. So if you have loans for this type of activities, the interest deduction is claimed as a 4 type on another schedule, not our Schedule A for itemized. Also, student loan interest is a 4 AGI deductions. These two here, yeah, are 4 type, the good or better type of deductions. Whereas the biggest deductions a lot of people have would be the home mortgage interest and possibly investment interest expense deduction. These two are the from type that we're focusing on here in chapter 7 that are reported on a schedule letter A. So the four type deductions are that trade or business, student loan, deducted to get the adjusted gross income. And the from type, this is the itemized deductions. And again, the big one would be the home mortgage interest deduction. Let's first talk about the student loan interest, even though it's not an itemized deduction. Student loan interest, the maximum you can deduct in any 1 year is $2,500. If you pay more than this in any 1 year, this is the maximum. So maybe a tactic would be to try to spread out the amount of interest if you're going to deduct it. There's also a phase out of this deduction based upon the taxpayer's adjusted gross income. In the case of single filing status, if you earn this amount, that maximum will start to decrease. And I believe it totally phases out at another 15,000 or 80,000. In the case of married filing joint, it'll go up to another 30,000 before it's totally phased out. So that's 160,000 AGI. Now, the time you borrow the money when you're in school, you have to use the borrowed student loan for qualifying costs like these here. Keeping in mind there may be other tax benefits of incurring tuition and book costs and fee costs, like the tax credits we'll talk about in our last chapter. Now, when you start paying back the money, that may be a few years after you've gone to school, after you incurred this cost. But you have to look back and see whether that loan was used for qualifying costs. Otherwise, maybe when you start paying back the interest, at least part of this may not be deductible. Maybe one of the big costs would be transportation costs, flying to or going home from school to your school between your mainland school and here in Hawaii. That's a qualifying cost, at least for student loan. Here's the form you get when you start paying off your student loan interest, a form 1099E, and here's the amount of student loan interest that you may be able to deduct up to those limitations we just had seen. To calculate that limitation, you would be using this worksheet in the instructions to the 1040 form. And you can see the dollar limit and the phase out beginning ranges, and the looks like the actual length of those ranges here. Again, the student loan interest deduction is a for AGI deduction, not an itemized deduction. Let's take a look at itemized deductions Schedule A, specifically interest that we're focusing on. So the two groups, one deals with your home mortgage interest, and the other one here deals with borrowing money to make investments, investment interest expense or deduction. The home mortgage interest deduction can be divided possibly up in 2 or 3 different categories. The main one is to borrow money to buy your residence, a so-called qualifying residence, a residence that you're not using for business, not using for rental property. It has to be used as your home. In fact, you can have up to 2 residences that you deduct the mortgage interest. Again, but these cannot be used for rental. These cannot be used for business. If you do use it for rental purposes, a mixture between your personal use and rental, we've seen some vacation home rules in the previous chapter limiting or possibly allocating costs among the 2 different activities. To be able to claim a home mortgage interest deduction, the loan is documented by what we call a promissory note. And then the title to the property is on another piece of paper called a deed. And then if you borrow money on this note, the lender wants to foreclose on you if you cannot pay back, right? So another piece of paper called a mortgage is the right for the lender to claim the property if you default on the note. So most people call this note a mortgage. Yeah, home mortgage loan interest deduction is really on this note here, and it's being charged a certain % interest rate. So you have to be on this loan, legally liable to claim the deduction. You have to be entitled to the property to legally claim that home mortgage interest deduction. You have to use it as your residence, be it your first or second residence, to be able to claim the deduction. And the interest deduction can only be claimed on the first $1 million of qualifying loan. Qualifying means that loan was used to buy the property, to construct the home, to construct the improvements. Okay, that's up to 1 million. So if you have a loan bigger than 1 million, possibly the interest on that loan may not be fully deductible. For example, if your loan was exactly 2 million for the whole year, and of course it may go up or down based upon if you're paying off your principal, but assuming it's a 2 million for the whole year, that means just half of your home mortgage interest deduction on this loan is a deduction, because you went over the limit. Of course, most of us can't afford $1 million loan, so probably we won't hit this limitation. There's another loan you can take out on your home that you don't have to use for acquiring. Again, that first loan is called acquisition debt, yeah, indebtedness, borrowing money to buy the home, to construct the home. And you can use your equity in your home, that's the value over the mortgage, a home equity line of credit, for another $100,000 of loan. And the interest on this can be deductible. So that's 1 million of acquisition debt and up to another 100,000 for home equity loan debt. Here it mentions that the value cannot go below the amount of you borrowing, otherwise that excess related interest is not deductible. Again, this last bullet here, $1 million of acquisition debt and another 100,000 of home equity loan debt. It's not interest here, it's the debt, yeah, limits. The interest on this debt is what's deductible. Points are also deductible like we had mentioned in our previous chapter. So here is a Form 1098 reporting the amount of interest that was paid during the year. And here is the amount of debt at the beginning of the year. Of course, again, if it's over a million, you know part of this interest is going to be non-deductible. Points deductible here if it's for the acquisition of your personal residence. And we went through the rules in the previous chapter. Something new is the, not mentioned before, is the mortgage insurance premium. And it could be deductible, I believe, if the loan is, or the AGI of the taxpayer is under $100,000. There's a phase out, I think, if you go over that. Here it says that interest related to trade or business is usually going to be reported on a different form, not as itemized deductions. And we'll talk about passive loss limitations in a future chapter. Now, if you borrow money and buy investments that's not a trade or business, not rental property, you may be able to deduct that interest expense based upon a limit here called net investment income. And it's better shown on the form that we calculate this deduction. So here is the amount of interest you're paying when you borrowed money to make investments. The typical investments would be stock, maybe raw land. Again, if you borrow money for a trade or business or rental property, that's not going to be investment interest expense. That's going to be a trade or business expense or production of income expense. So here's the amount you had paid in interest during the year. Here's an amount you were unable to deduct in previous years. So here's the total interest you possibly can deduct for the current year. But it's subject to a limitation called net investment income. Again, here's how much interest you paid. Here's the limitation. You're going to look at your investment income minus investment expenses to get net investment income. Again, investment income minus investment expenses equals net investment income. So here is income, line 4. Here is expenses, line 5. Minus the two, line 4 and 5, here's your net investment income. And you can deduct your interest expense to the extent of your net investment income. Looks like this number down here. And any excess interest over the investment income you get to carry over to next year and subject to the same limitation. What's a little strange is that your investment income, line 4 here, we have to back out the qualified dividends. We may have to back out the capital gains, really net long-term capital gains. The reason why is that qualified dividends and net long-term capital gains get taxed at lower rates. So allowing an interest deduction on that type of income would be a double benefit. It may be possible where you don't try to take the lower rates for these items. Then possibly you can add it back into as investment income, increasing the deduction if you do have investment interests that may be deferred instead. Okay, so this amount here is reported as an itemized deduction back on Schedule A. So when can you deduct interest? If you're a cash basis taxpayer like most people, is when you pay it. If you try to prepay it, it will be disallowed. It has to be due at the time you pay it, otherwise you're going to be able to deduct it later on, maybe the next year when it's due. If you borrow money and use that same borrowed money to pay back interest, generally that's not a deduction. Now if you borrow new money, a new loan, and pay off an old loan, then possibly the interest on that older loan is deductible. But again, if you use that same loan and pay it back with that proceeds you just borrowed, generally it's not deductible. So that's why typically when you borrow money on a closing of a new home, you have to put down some kind of down payment. And probably from that down payment, you are making actual cash payments to pay the points that makes the points deductible at that time. Discounting notes basically is just a different calculation on the amount of interest that's due. If you borrow or lend money to a related party, there is the potential of manipulating or moving income deductions around the party. So you gotta charge a fair market interest rate. Okay, next category of itemized deductions are charitable contributions. So a lot of times you hear the term a charity is a 501c3 organization. So this IRS code section makes the organization a charity. Generally, charities are tax-free entity generally. Yeah. So the contributions they receive are income tax-free to the organization. What allows taxpayers to deduct their contributions is not this section by itself, but IRS Section 170 says that contributions to charities are deductible. But you got to make sure the organization is a charity. All charities are non-profit organizations. All non-profit organizations are not charities. So you got to be clear that the organization you're giving to is a charity. I have a link in our Laulima chapter folder where you can go to the IRS website to double check whether an organization is a registered 501c3. The Hawaii Department of Commerce and Consumer Affairs also has a website that um, Hawaii charities also have to register with that can be checked. There's two types of things you can give a charity. One is cash and the other is non-cash. Yeah, property other than cash. Of course, cash is the easy thing to value. If you give non-cash, now you have to know what the value is. The easy thing that's non-cash to value would be stock securities, bonds. Yeah, the market price would be probably available online. If you have a tangible asset, then maybe you need to get an appraiser to find out how much it's worth, and you have to pay for that. Here in this bullet it says that you have to reduce your contribution for anything you get back from the charity. So a lot of times charities or nonprofits have fundraising. They start selling stuff like cookies or tickets to events. Generally, those items are non-deductible because you're getting back something, you're buying something. If the charity is raising money by selling something, for you to claim a deduction, the thing you're buying has to have or the receipt you have has to show how much is deductible. Otherwise, you can pretty much assume what you're giving is non-deductible. You're actually buying something and not contributing. There are limitations to the amount you can deduct each year. And if you cannot deduct the amount in any one year, you can carry it over to the next 5 years. And after that, the unused contribution expires. This is unlike the unused capital losses that were be able to carry it over by the taxpayers until their death. Here it will expire after 5 years from the contribution year. So our Schedule A, here is cash contributions, including checks and credit card charges. And here's everything else that's not cash. So you have to make sure you have good receipts, or what they call donee acknowledgments, actually telling you that what you had contributed is a charitable contribution. If the non-cash contribution is over $500, you have to fill out this form documenting, reporting non-cash contribution information to the IRS. So cash contributions, non-cash contributions, here is amounts that you're carrying over from the previous years that were unused. and then the total. Now, even though you don't see it here, like the medical limit AGI limitation we saw at the top of Schedule A, there is an AGI limitation or AGI limitations to charitable contributions. Here are the types of organizations that generally you can deduct contributions to. Here's that 501c3. Churches also fall under 501c3, but generally churches don't have a filing requirement with the IRS like other nonprofits. Um, these generally still have to be 501c3s to be able to classify them as charities, yeah? Contributions to be deductible. Now, who would want to give money back to the government, yeah? It's just like a tax, and taxes are non-deductible, but if for any reason you're giving extra money back to the government, you can deduct that as a charitable contribution. This chart is very detailed, but I think rather good in terms of determining the limitations that you can deduct in any one year. Keeping in mind there's percent limitations that are really listed on the next slide. So let's zoom in here. So the first question they're asking is whether the contribution was a cash, yes, or non-cash, no. So the easy one would be cash. And are you contributing it to a public charity? Of course, it's going to be a charity now. The question is it a public charity or a private foundation? If it's a public charity, like we hear always in the news, like the Aloha United Way or American Red Cross or Goodwill or Girl Scouts, that cash contribution should be fully deductible. If it's amount donated equals cash amount. Um, well, either way, the amount you can deduct is deductible, but if you get something back, yeah, from the charity, you have to reduce your contribution by anything that you get back that's tangible. Okay, so let's go to non-cash contributions here. So the question here is whether the property is a capital gain property. So if you remember back in the previous chapter, capital gain property, capital assets was defined by things that weren't capital assets. So down here is stuff that's not capital assets. The main one would be business inventory, business supplies that are contributed by the business to charities. So basically here as individuals, these are stuff we own, like your used car, used clothing, all the stuff you give to Goodwill. But even investments are capital assets going this way here. So what you're giving is to a public charity. If no, then what you can deduct, here they say fair market value less any gain. Basically, you get to deduct the cost of what you had bought it at. Okay, if the fair market value is bigger than the cost, you deduct the lower, yeah, the value or the cost. Here, if it is a public charity, yes, then is it a tangible property? Can you physically feel it like your car, like your used clothing? If not, it's more like that stock securities, and you get to deduct the value, assuming you had the property for more than a year. That's a long-term capital gain property, the value, the increased value, and you don't have to pay any tax on the profit that you had donated. If that property donated is like a car, is like used clothing, or the extreme would be like a work of art that's appreciated in value. Here it says, is the donee, the charity, going to use it within their own business? And if yes, then you get to deduct the value. Like that painting donated to the museum, increasing value, you get to deduct the value. Or if that used car, that kidney car, that Goodwill clothes you donated, they're not going to use it in their organization. They're going to sell it. Here you get to deduct, related to donatee's purpose. you get to deduct the value. Here you get to deduct, um, sorry, here you get to deduct the cost or the amount they sell it at. Okay, so I forgot this word. It's not related, it's unrelated. So they're selling the property, yes, here. So you have to wait to find out how much they sell it for. Now that's what you get to deduct. Here, if they use it within their own organization, okay, unrelated is a double negative. Unrelated and no, they are using it for their purposes. You get to deduct that higher value. Okay, and then ordinary property, again, business property being contributed. Generally, you get to deduct the cost plus maybe a little bit more here if it's inventory that can be sold at a profit. If you donate services, donate the use of property, there is no deduction because you have no basis in that your services. Yeah. So this next slide is really linked to the previous slide telling you what the percent limitations are. But let me kind of summarize it maybe on this screen. If you're a corporation and you donate um, charitable contributions, you have a 10% limit on the corporation's taxable income that can be contributed and deducted. Anything in excess of this can be carried over, I guess, a few years, maybe that 5-year limit. I think it might be the same or might be a little bit different than an individual. The limits here down here are for individuals, non-corporations. So in the case of a 50%, what we're talking about here is AGI. In the case of a corporation, we're talking about taxable income. A corporation doesn't have AGI, yeah? Just individuals like you and me. So the general limitation is 50% if it's a cash contribution going to a public charity. Sorry for my bad spelling here and bad penmanship. Just used to the computer keyboards. If an individual contributes non-cash to a public charity, then the limitation is 30% of AGI. If an individual contributes cash to a private charity, sometimes they call it private foundations, like the Bill and Melinda Gates Foundation. They don't accept money from the public, and they get to deduct, at least in any 1 year, 30% of their contribution or 30% of their AGI. If it's non-cash going to a foundation, then it's 20% of AGI. Casualty and theft loss is another category of itemized deductions, and we'll see the actual calculation in our next chapter, chapter 8. Miscellaneous deductions is the last section of Schedule A, and it can be divided up into basically 3, maybe even 4 categories. So here's miscellaneous, and here's one group called unreimbursed employee expenses. So if you're working for someone else as an employee and you pay costs to do your job and are unreimbursed, then you get to claim that deductions over here. Maybe you have to give more detail on this form 21 or 6 that calculates a lot of the business use of an automobile. But other stuff like travel, business travel, union dues are all included on that form or tallied up here with a small description. Another category of miscellaneous deductions would be ones related to preparing your tax return or possibly tax planning. So here's your H&R Block fee or the fee you paid for that TurboTax software or tax cut, whatever you pay for online services. The third type is related to investment expenses. So this is the one we had seen used when we calculated the investment interest expense deduction. stuff like safety deposit rental fees, um, financial planning fees or advisory fees, maybe magazine subscriptions to financial journals or financial subscriptions like Wall Street Journal. So you take a total and then AGI goes here. 2% of AGI is now subtracted from this miscellaneous to get what's left over to be deductible, which may be zero if you have little amounts of deductions and a big AGI. Now, the next section is also miscellaneous. Yeah, just like this miscellaneous here. But these miscellaneous deductions that have no description here that you gotta fill in has no 2% AGI reduction. So the main one you may see here, especially for Hawaii residents, is when they go to Vegas and they hit the jackpot and they have to claim their gambling winnings back on the 1040 form. I believe it's line 21 for other income. And you don't reduce that income back on the 1040 form for any gambling losses. Gambling losses are claimed over here, to the extent there's gambling winnings being reported back on the 1040 form. If your losses are larger than the winnings, you only can claim here the losses up to the winning amount for the year now. Yeah, here's all the winnings for the year, and here's all the losses being deducted for the year, up to the amount of the winnings reported back on the 1040 form. There are some rare types of other ones being reported here, line 28. An example would be if you have a retiree collecting a company's retirement pay, and not all of it is being deducted because they had made contributions during their work life, but they pass away before recovering all of that non-taxable contributions. In the last tax return for in the year they passed away, they can claim here a deduction for that unrecovered tax-free contributions that they haven't gotten back. Total itemized deductions. Of course, should be larger than the standard. Now, for taxpayers that have large incomes, this amount may be reduced. The reduction or the limitation is sometimes using the name, I believe it's pronounced peace limitations. And it depends upon the taxpayer's filing status. So here on the next screen is a worksheet coming from the instructions for Schedule A. So here's basically all the itemized deductions, and then I believe certain ones that are not going to be reduced for the peace limitations. In other words, I guess this is taxes, most interest deductions, charitable contributions, one of these here, could be reduced if the taxpayer's adjusted gross income exceeds these dollar amounts based upon their filing status. The most those deductions can be reduced is 80%. Now, again, not all are going to be reduced, like medical, investment interest, expense, what is this? Casualty loss are not reduced. But these others can be reduced up to 80%. And it's a phase in of the reduction based upon going over AGI, going over these limits. The phase in is at a rate of 3%, ultimately reducing the amount that's deductible back on that bottom line of Schedule A. Okay, and that's it for chapter 7. If you have questions, you know how to reach me. Okay, otherwise I'll see you in the next chapter.